This morning, the U.S. economy released a jobs report so bad that even analysts dismissed as perma-bears went quiet. February 2026, non-farm payrolls, negative 92,000. The U.S. economy didn't just stop adding jobs, it lost them. 92,000 Americans who had jobs in January no longer have them in February. The estimate was a gain of 59,000. The actual number came in at minus 92,000. A miss of 151,000 jobs, a single month. And the revision made it worse. December, originally 48,000 jobs gained, was revised down to negative 17,000. January was revised down by 4,000. 2 prior months of apparent strength turned out to be a weakness in disguise. In total, 69,000 more jobs had already been lost than official reports admitted. The labor market was already weaker than anyone knew. The unemployment rate moved to 4.4%. February marked the third time in 5 months that the U.S. economy shed jobs. The last time that happened, 5 months of job losses in a single year, was 2010. When the U.S. was still digging out from the wreckage of the 2008 financial crisis. The market heard this number. The Dow fell, the S&P 500 fell. Futures had already been signaling a bad open before the data even printed. This jobs report landed on top of a week that had already destroyed enormous amounts of wealth across every major asset class simultaneously. Let's add it up. Because the $3 trillion in the headline of this video is not an exaggeration. It is a conservative accounting of what has been lost from equities, software stocks, private credit funds, precious metals, and household balance sheets. In the span of roughly 6 weeks. 6 weeks that most investors are still trying to process as isolated events, rather than recognizing for what they actually are. The beginning of the 2026 crash, where the $3 trillion actually came from. Let's account for the money, because trillions vanished sounds abstract until you trace exactly where it went. Layer 1, software stocks. In the span of 7 trading days in early February, the iShares software ETF lost nearly $1 trillion in market value. An entire $1 trillion erased from the sector in less than 2 weeks. According to JP Morgan, software had undergone the largest non-recessionary 12-month drawdown in over 30 years, down 34%, wiping out approximately $2 trillion from peak and reducing the sector's weight in the S&P 500 from 12% to 8.4%. This wasn't gradual erosion. It was a structural repricing driven by a single shattering realization that AI doesn't just create value for software companies. For many of them, AI destroys their business model entirely. The same tools that made software companies look invincible in 2023 and 2024 are now positioned to replace what they sell. Layer 2, precious metals. On January 31st, gold, which had run to nearly $5,600 per ounce, fell roughly 11% in a single intraday session. Silver, which had surged past $120, collapsed 31% to $78.53. According to the detailed anatomy of February's sell-off compiled by financial analyst Michael Brendorfer, an estimated $15 trillion in paper wealth disappeared from precious metals markets in just 2 trading sessions. The CME Group hiked margin requirements 36% for silver and 33% for gold, forcing leveraged holders to liquidate at any price available. What was supposed to be the ultimate safe haven became a forced selling event. Layer 3, private credit. Blackstone's flagship private credit fund, the $82 billion BCRED, reported $3.7 billion in withdrawal requests. In the first quarter of 2026, the largest redemption wave in the fund's history, requests totaled 7.9% of net asset value, far above the fund's normal 5% quarterly cap. Blackstone was forced to raise the cap to 7% and inject $400 million of internal employee capital, just to satisfy all the requests. Blue Owl Capital had already halted redemptions entirely from a separate private credit vehicle. RA Stanger, which closely tracks alternative assets, projected a 40% year-over-year decline in business development company capital formation for 2026. 40%. For an asset class that had positioned itself as the cornerstone of institutional portfolios for the next decade. Layer 4, the broader equity market. The S&P 500, which briefly touched an all-time high of 7,002 in late January, had lost all its 2026 gains by early February. By the time the Iran conflict accelerated selling in early March, the index had fallen roughly 4% below its late January record. The Nasdaq suffered its worst 3-day stretch since April. The Russell 2000 dropped roughly 2% in a single session. South Korea's Kospi fell over 5% in a single day and triggered circuit breakers. Bitcoin crashed from above $126,000 to touch $60,000, its lowest price in over a year, as exchanges liquidated more than $1 billion in leveraged crypto positions in 24 hours. Every asset class, simultaneously in 6 weeks. This is the tell. When correlations go to 1, when stocks, bonds, gold, crypto, private credit, and real estate all fall together, it is not a sector rotation. It is not a technical correction. It is liquidity leaving the system, capital not moving from one pocket to another but disappearing from existence because the prices at which assets were being held were not prices that real buyers were willing to pay under stress. The $3 trillion is not a figure that captures the full scope of what has been lost. It is the portion that has been documented in the first 6 weeks. The question is not whether this is the beginning of the 2026 crash. The evidence for that is already settled. The question is how far phase 2 of this unwinding has left to run. The jobs report that changes everything. This morning's payrolls data demands its own section. It's not just another weak data point. It's a structural signal that fundamentally changes the Federal Reserve's position and the market's recovery thesis. The consensus was modest, but positive. Roughly 59,000 jobs added. A weak number, but positive. An economy slowing, but still growing. Instead, it shed 92,000 jobs. Payrolls have gone negative for the third time in 5 months. The year 2025, initially reported as adding 584,000 jobs, is now revised to just 181,000, an average of 15,000 jobs per month. For context, the U.S. needs 100,000 to 150,000 new jobs monthly just to absorb new workers. For the entire year, the economy barely kept pace with that threshold, falling far short in multiple months. Federal government employment is down 330,000 jobs, 11% of its total workforce since October 2024. Information sector jobs have trended negative for months. Manufacturing shed 12,000 in February. Transportation and warehousing lost 157,000 jobs, a 2.4% decline since its peak in February 2025. This marks a full year of steady contraction in one of the economy's most cyclically sensitive sectors. Average long-term unemployment rose to 25.7 weeks, the longest since December 2021. The door for losing your job is not particularly wide open. But the door for getting a new one once you've lost it is narrowing fast. Bankrate's senior analyst Mark Hamrick called the report ugly without qualification. Principal Asset Management's chief global strategist Seema Shah stated that the data delivers a stagflationary tilt to the macro backdrop, an uncomfortable development for markets already navigating unusually fast-moving cross-currents. Stagflationary tilt, that phrase from a major asset manager published the same day the report printed. It is the phrase that every investor needs to sit with. Stagflation, rising prices, declining employment, an economy simultaneously too hot for the Fed to cut and too cold to sustain without cuts. There is no clean solution to stagflation. There never has been. When Paul Volcker broke the stagflation of the late 1970s, he engineered the worst recession since the Great Depression. Unemployment above 10%, the housing market temporarily destroyed, years of economic pain. That was the cure, and the patient nearly didn't survive the treatment. The Federal Reserve today faces that same diagnosis with half the tools and twice the debt. A political environment where the president demands rate cuts publicly for months, while simultaneously waging a war driving oil above $80 per barrel and pushing inflation expectations higher, the private credit crack that the mainstream hasn't processed. Most investors watching this week's market moves have focused on the visible: equity index levels, oil prices, and jobs headlines. What they haven't processed is the Blackstone story. And the Blackstone story is the most important signal of all. Here is why. Blackstone's BCRED is not a marginal or poorly managed fund. It is the largest non-traded business development company in the world. It manages $82 billion and has delivered a 9.8% annualized total return since inception. It has met every single redemption request in every quarter since its launch. This is the gold standard of private credit, the fund that proved the concept, the benchmark against which the entire $2 trillion private credit industry measures itself. And it just reported the highest redemption rate in its history. Requests so large they blew through the normal 5% cap. High enough that Blackstone had to lift the limit, inject $400 million of its own and its employees' money into the fund, and simultaneously watch its stock fall 8% to a 2-year low in a single session. JP Morgan's analysts described this as the first quarterly outflow for BCRED, a meaningful designation, and called it a significant expression of souring investor sentiment toward direct lending. R.A. Stanger, the most closely watched tracker of alternative asset flows, compared what is now happening in private credit to the 2023 collapse of Blackstone's real estate fund, when Blackstone was forced to gate withdrawals. And the bright fund name became synonymous with a cautionary tale about illiquid assets sold to retail investors as safe alternatives. That comparison is critical. In 2023, Blackstone's real estate fund gated withdrawals when redemption requests exceeded its capacity to pay. The aftermath reshaped the entire non-traded real estate industry. Valuations were remarked, capital formation collapsed, investor trust took years to rebuild. Private credit in 2026 is now at the same inflection point that non-traded real estate was at in late 2023, and private credit is 3 times larger. The $2 trillion private credit industry grew because it offered something bank loans couldn't: customized terms and patient capital, and returns that weren't marked to market daily, no volatility on the screen. No panicky daily pricing, just stable reported returns. That stability was the product. But that stability was also, in part, an illusion. Private loans don't get repriced like publicly traded bonds. Underlying borrowers, like middle market companies and leveraged buyout vehicles, face stress. Software companies, now facing AI-driven disruption, are under the same stress as other corporate borrowers. They just don't show it on a public ticker. Retail investors pulling money from private credit funds at 7.9% per quarter are not panicking irrationally. They are rationally deciding that they would rather hold cash or public bonds where they can exit at any time than hold an illiquid loan portfolio that may contain more stress than the quarterly NAV report acknowledges. That rational decision, multiplied across thousands of investors, becomes a structural problem for the funds, and the structural problem becomes a credit availability problem for mid-market companies. The credit availability problem becomes an employment problem, and the employment problem becomes a consumer spending problem, and the consumer spending problem becomes a corporate earnings problem. This is how financial contagion works, not through a single catastrophic event, through a sequence of rational individual decisions that collectively unwind a system that was always more fragile than it looked. The jobs report that changes everything. This morning's payrolls data demands its own section, because it is not just another weak data point, it is a structural signal that fundamentally changes the Federal Reserve's position and the market's recovery thesis simultaneously. The consensus going into today's report was modest but positive. Roughly 59,000 jobs added. A weak number, but positive. An economy slowing, but still growing. Instead, the economy shed 92,000 jobs. The third time in 5 months, payrolls have gone negative. The year 2025, initially reported as adding 584,000 total jobs, has now been revised to just 181,000, an average of 15,000 jobs per month. For context, the U.S. needs roughly 100,000 to 150,000 new jobs per month just to absorb new workers. For the entire year, the economy was barely keeping pace with that threshold on average, and in multiple individual months, it fell far short. Federal government employment is down 330,000 jobs, 11% of its total workforce, since October 2024. Information sector jobs have been trending negative for months. Manufacturing shed 12,000 in February. Transportation and warehousing has now lost 157,000 jobs, a 2.4% decline since its peak in February 2025. A full year of steady contraction in one of the economy's most cyclically sensitive sectors. Average long-term unemployment, the duration that the average unemployed person has now been out of work, rose to 25.7 weeks. The longest since December 2021. The door for losing your job is not particularly wide open, but the door for getting a new one once you've lost it is narrowing fast. 3 signals that are now simultaneously flashing. Step back from the individual events. The jobs miss, the Blackstone outflows, the oil shock, the software wipeout, and look at what all of them are signaling in aggregate. Signal 1, the labor market has quietly entered contraction. 5 months of job losses in 2025, confirmed only after revision. February 2026, losing 92,000 jobs outright. The year 2025's original 584,000 jobs reported, corrected to 181,000 actual. The economy had been weaker for far longer than anyone was told, and now, with federal employment down 330,000 from its peak, and AI-driven automation accelerating layoffs in information and technology sectors, the underlying trajectory is getting worse, not better. Signal 2, private credit. The $2 trillion shadow banking system that replaced traditional bank lending for an entire generation of corporate borrowers is showing its first serious signs of structural stress. The Bicarete redemption wave is not isolated. Blue Owl has already halted withdrawals from one vehicle. UK mortgage lender Market Financial Solutions collapsed on Friday, reviving what Jamie Dimon called the cockroach warning. When you find one problem, there are more you haven't found yet. Signal 3, the bond and equity markets are now sending violently contradictory signals simultaneously. On Friday, wages came in above expectations, 3.8% year over year, which means inflation pressures are not abating. At the same time, the economy lost 92,000 jobs, rising wages, falling employment. That is the definition of stagflation developing in real time in the actual data published by the Bureau of Labor Statistics this morning. Not a projection, not a model, the actual numbers when these 3 signals appear simultaneously. Labor market contraction, private credit stress, and stagflationary wage and employment data, the historical precedent is not ambiguous. In every prior instance, when all 3 conditions aligned, the National Bureau of Economic Research eventually dated a recession as having already begun, usually 6 to 12 months after the signals first appeared. Usually after the data had been revised to confirm what the early readings were already saying. The data is saying it right now. The question everyone is avoiding, is this the beginning of the 2026 crash? That question assumes a clean answer. It assumes there will be a definitive moment, a day, an event, a headline, that every investor looks back on and says, That was when it started. There won't be. There never is. Not at the beginning. Only in retrospect. What we know with certainty, documented in official Bureau of Labor Statistics data released this morning, in Blackstone SEC filings released this week, in JP Morgan and Bloomberg research published this month, is the following. Software stocks have suffered the largest non-recessionary 12-month drawdown in over 30 years, wiping out approximately $2 trillion in market value and reducing the sector's weight in the S&P 500 from 12% to 8.4%. Blackstone's flagship private credit fund faced a record 7.9% redemption request, forcing Blackstone to lift its usual 5% cap and inject $400 million of employee capital to meet all requests, the first quarterly net outflow in the fund's history, according to JP Morgan. The U.S. economy lost 92,000 jobs in February, the third time in 5 months that payrolls declined, with the unemployment rate rising to 4.4%, and 2025's total job gains revised down from 584,000 to just 181,000. The S&P 500 has failed to reclaim its all-time high of 7,002 set in late January. The index is negative for the year. The Iran conflict has added an oil shock that makes the Federal Reserve's job immeasurably harder. Every one of these facts was established in the last 6 weeks. Every one of them points in the same direction. This isn't the beginning of a possible crash. This is the beginning of a confirmed one. The question left to answer, the only one that matters now, is whether you are watching this as someone who is already prepared, or as someone who is still deciding whether to take it seriously. The data made its decision this morning. At 8:30 Eastern, negative 92,000 jobs. The market heard it. Now you have too.